Broadcom is currently trapped in a state of valuation paradox. Think about that for a second. Its net income just exploded by 33%, yet the market is aggressively slashing its premium, creating a massive 63% valuation gap. Is this a warning of a hidden trap, or are we looking at the greatest mispricing of the decade? To answer that, we have to look past the ticker symbol and into the heart of a company that is fundamentally changing how it operates in a rapidly evolving technological landscape. Broadcom's earnings per share recently surged to $5.11. Usually that is a clear signal for the market to celebrate and drive the price higher. Instead, the PE ratio, which is essentially the sticker price investors are willing to pay for every dollar of a company's profit, actually contracted from 77 down to 66 in a single year. In the world of high-growth technology, this is a mathematical anomaly that should make every serious investor pause. It is like finding a luxury car that just got a faster engine but is somehow sitting on the lot with a massive discount. Typically, when a company delivers double-digit revenue growth and an earnings explosion, the market rewards it with a higher multiple, often called a growth premium. But here we see the opposite, a valuation derating. You will hear the mainstream financial press say investors are becoming conservative, perhaps sensing an invisible ceiling for semiconductor demand or worrying about general market volatility. But when we look under the hood, we have to ask a deeper question. Is Broadcom becoming too efficient for its own good? Is the market simply unable to keep up with the sheer speed of its operational improvement? As we dive into this stock market analysis, remember the golden rule. Distinguish between a company that is slowing down and a company that is simply outrunning the market's ability to price it accurately. This PE compression suggests that while the business is accelerating, the sentiment is decelerating. This creates a friction point where the fundamental reality of the company's bank account is at odds with the perception on your screen. When sentiment and fundamentals disagree this violently, the gap is usually closed by a massive price correction, and the direction of that correction depends on who is right, the math or the mood. To understand if this friction is a temporary hiccup or a structural flaw, we have to examine the recent margin divergence. This is where the story gets even more interesting. While Broadcom's annual net margin, the percentage of revenue left over after all expenses are paid, expanded to a healthy 38%, the most recent quarter showed a sharp, sudden decline. It dropped from 47% down to 38%. That is a 920 basis point drop in a very short window. At first glance, this looks like a red flag. It suggests that the easy wins from recent integrations, like the massive VMware acquisition, might be over. Investors often fear that when a company makes a giant purchase, the complexity will eventually lead to bloated costs and lower efficiency. But here is the twist. This margin compression is happening simultaneously with a 29% surge in top-line revenue. This is a classic scale-up signal. When a titan like Broadcom moves into a new phase of dominance, they often sacrifice short-term margin percentage to capture massive long-term revenue velocity. They are trading a bit of efficiency today for a lot of market share tomorrow. The lesson for your portfolio is simple. Never judge a margin drop in isolation. If margins are falling while revenue is skyrocketing, you aren't looking at a failing business. You are looking at a business that is aggressively reinvesting in its own dominance. Once you grasp this, you will start to look at financial reports in a completely new light, moving beyond simple percentages to see the actual strategy at play. This brings us to the most violent disagreement in modern finance, the tug-of-war between the Graham Intrinsic Value and the discounted cash flow model. This is where value investing gets complicated. If you are a disciple of Benjamin Graham and focus on conservative, tangible metrics, essentially valuing the company based on what it owns right now and its immediate past performance, you would conclude that Broadcom is 48% overvalued. To the traditional value investor, the current price is a bubble waiting to burst because the hard assets and current earnings do not seem to justify the premium. But if you shift your lens to a discounted cash flow model, which is a way of projecting all the future cash a company will generate and discounting it back to what it is worth in today's dollars, the math tells a completely different story. It says Broadcom is actually 15% undervalued. This $162 per share discrepancy represents the ultimate investor dilemma. Is Broadcom a legacy hardware play or a perpetual growth engine fueled by software? The market is currently paralyzed by this question. If you rely on just one valuation metric, you are essentially flying a plane with half your instruments blacked out. This is why a robust investing strategy requires looking at multiple angles, acknowledging that a company can look expensive to a bookkeeper but cheap to a visionary. But how does a company maintain such growth while carrying a staggering $63 billion in long-term debt? Most investors see that number and run for the hills, fearing that higher interest rates or supply disruptions will eventually crush the bottom line. But look closer at the debt to EBITDA ratio. EBITDA is basically earnings before the boring stuff, like interest, taxes, depreciation, and amortization. It is a measure of pure operational power. Despite the massive debt pile, the ratio actually improved, dropping from 628% to 595%. This is a masterclass in deleveraging through growth. Broadcom isn't just paying down debt, it is growing its operational engine so fast that the debt becomes smaller relative to its earning power every single day. Think of it like a bodybuilder gaining 50 pounds of muscle. Suddenly the heavy backpack they were carrying doesn't feel so heavy anymore. This is exactly why focusing on the absolute debt number is a rookie mistake. The professional analyst looks at the coverage and the velocity. As long as Broadcom's EBITDA expansion continues to outpace its interest obligations, that debt isn't a weight. It is a lever that amplifies returns for shareholders. It allows them to acquire massive assets like VMware without diluting the value for current stockholders. However, there is a mystery on the balance sheet. The $2 billion Cash Vanishing Act. Despite reporting record-breaking revenue, the company's net cash and equivalents declined significantly. To the untrained eye, this looks like a liquidity crunch. But when you compare this to rivals like Intel, a different narrative emerges. This isn't a loss of money, it is a deliberate, aggressive reallocation of capital. Broadcom is stripping its balance sheet of immediate safety nets to fund a pivot toward next-generation semiconductor dominance and artificial intelligence infrastructure. They are betting that their operational cash flow is so reliable that they don't need to sit on a mountain of lazy cash. In a world where people often say cash is king, Broadcom is arguing that cash flow is the kingdom. They would rather put every dollar to work building the future than let it sit in a bank account earning minimal interest. This is something you can easily check for yourself by looking at their statement of cash flows, which shows where the money is actually going. If you're wondering whether this lean strategy is too risky, look at the hidden safety cushions, the Piotrowski F-score and the Altman Z-score. For those of you new to these metrics, think of them as the stress tests of the investing world. Broadcom holds an F-score of 8 out of 9. An F-score measures the health of a company's internal machinery, looking at things like the quality of earnings, the stability of margins, and current liquidity. A score of 8 is near perfect, indicating that the business is running like a finely tuned watch. Then there is the Altman Z-score, which uses a specific formula to predict the likelihood of a company going bust within the next 2 years. A score above 3 is considered safe. Broadcom's score is 12.45. That is not just safe, that is a fortress. This fundamental analysis provides a powerful counter-argument to any fears of an economic slowdown. It proves that beneath the surface-level market volatility, the company's core foundation is rock solid. The market might be confused about the price, but the math is not confused about the quality. When you have a Z-score that high, you have the breathing room to make bold moves while others are playing defense. There is, however, one area where Broadcom is still underperforming, and it represents what I call a coiled spring opportunity. The asset turnover ratio currently sits at 0.40. This ratio tells us how efficiently a company uses its assets to generate revenue. Right now, Broadcom's massive $169 billion asset base is still significantly underutilized. Think of this as a high-performance engine that is currently only being driven in third gear. This is largely due to the recent acquisitions that haven't been fully integrated into the revenue stream yet. If management can bridge the gap between these massive infrastructure investments and immediate revenue generation, the upside could be explosive. Keep your eyes on that 0.40. If that number starts to tick towards 0.5 or 0.6, the resulting surge in revenue velocity will force the market to close that 63% valuation gap almost overnight. Efficiency is the final frontier for Broadcom. They have the size, they have the technology, and they have the market position. Now they just need to turn the key on their existing assets. This is a simple rule, but it is incredibly powerful for anyone performing a serious stock market analysis. This leads us to the ultimate moonshot scenario, the 55% free cash flow margin. Our fundamental analysis reveals that if Broadcom can achieve just a 13 percentage point increase in its free cash flow margin through operational optimization, it would inject an additional $8.6 billion into its coffers annually. This isn't a fantasy. It is a roadmap based on the company's history of ruthlessly cutting costs and finding efficiencies after major acquisitions. The company is currently optimizing its software-defined infrastructure to a point where every dollar of revenue becomes increasingly profitable. If they hit this optimistic scenario within the next 24 months, the current price point will look like a historical bargain. We are talking about a level of profitability that very few companies in history have ever achieved. So let's return to the original question. Is the market right to derate Broadcom, or are we witnessing a massive disconnect? When you tie together the debt mastery, the fortress-like health scores, and the explosive earnings power, the verdict becomes clear. The valuation schizophrenia we are seeing is the result of a legacy market trying to price a futuristic entity using old tools. Broadcom is no longer just a chip maker, it is the fundamental utility company for the digital age. They provide the backbone for the cloud, for artificial intelligence, and for global connectivity. The 63% gap between its Graham value and its DCF potential isn't a sign of danger. It is a sign of a paradigm shift. The market is struggling to accept that a company with $63 billion in debt can also be one of the safest and most efficient operators in the world. This realization is at the heart of any sophisticated investing strategy. You have to be willing to look at the data and trust the math even when the crowd is shouting something else. The ultimate truth is that Broadcom has built a resilient, high-yield infrastructure titan that is currently being priced like a volatile hardware company. The recent dip in net margins and the decline in net cash are not cracks in the foundation, they are the dust kicked up by a company moving at high speed toward total market dominance. Broadcom is effectively deleveraging through growth, utilizing an asset base that most competitors could only dream of possessing. That is why I believe that within the next 24 months, we will see a great convergence where the market is forced to abandon its conservative, old-school value investing metrics in favor of the cash flow reality. I predict that as Broadcom hits that 55% free cash flow target, the current valuation derating will reverse violently. We're not just looking at a stock, we are looking at the emergence of a new category of industrial power. While the crowd focuses on short-term policy shifts and regional tensions, the savvy investor will recognize that the fortress has already been built, and the market is just now realizing who owns the keys. But I want to hear your take. Do you think the market is right to be cautious about Broadcom's massive debt, or is the cash flow potential simply too big to ignore? Do you see the 63% gap as a red flag or a green light? Let me know your thoughts in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.